This is John Person. Thank you for joining us in our house, or the house that Person's Planet built. The indicators, Person's pivots, as well as the PPS indicator are widely used. Tonight I have a mixed presentation between a PowerPoint analysis that we did and style of things that we try to teach people to become a little bit more astute in the changing times. And I think when I say changing times, I think you'll clearly see tonight a couple indicators of why we've been using for several years, because we need to adapt to changes in the marketplace. And there has been a pretty strong change. So with that said, let's get started right into tonight's presentation. First and foremost, let's go through this disclosure statement. It's fairly important. Risk of loss is, again, most people are familiar that there are no guarantee of results of using any of these methods. Past performance not indicative of future results. And I'll let you take a second to read the rest, and I think we're good. All right. So when I look for trades, and many people may not know this, but I started actually trading options on Treasury Bonds in it was about late 84, early 85. They were introduced to the Chicago Board of Trade. Was the very first commodity they introduced options on was Treasury Bonds. Just a little bit of history for you. And it's kind of coming back full circle, because we just did this morning in our trading community, and last night I even gave out, and even yesterday we gave out a particular scenario of a potential bullish convergence that was setting up in the TLT or the bonds, and looking for what I think we will see is a kind of a pause as we go from a trend to a consolidation phase in the bond market. Most of what I utilize is still everything I've done for the last 30 years. And many of you are familiar with the PPS indicator, the buy and the sells. If you're not, just to share with you, there are these kind of like arrows that give us buy and sell signals in the markets. Now, as a disclosure, tonight I'm actually broadcasting from Caesar's Palace at the World Money Show, so I'm not promising the best connectivity of, not to downplay anything, but the internet. I'm relying on Caesar's or Cox or whoever is their internet provider, so I'm going to be trying to do this as best as possible. With that said, the more platforms I have up, the more broad bandwidth I would be probably using. So I'm trying to get through as seamless as possible, and I'm only going to use the TradeStation platform, but in my presentation I have some really neat stuff in Thinkorswim, so please bear with me. But a lot of what we do, we have our buy and sell signals, and I use those because they're easy to scan. And one of the things that we're going to be doing here at the Money Show tomorrow night, I'm doing a presentation, is to show people how to use those scans to not just develop a sense of what to buy, what to sell, but also, very simple, if I come over and share with you guys real quick, on TradeStation version, we have several, if you'll notice up in the upper right corner, I have several different, I have 3 types of category buys. You'll notice where it says JPHCD. Well, we also have a daily high close doji, a weekly high close doji. So I actually have 5 different criteria that I search for different buy signals. And then again, the opposite is true for sell signals. So what are these criteria? Well, they're pretty smart actually. One's like, give me a buy signal when the weekly's in a buy. Another would be, throw me a buy signal at monthly support. And another one is, just throw me any PPS buy signal, which is what you can literally get out of Thinkorswim. So I don't want to be, just to let people know, it's available on multiple platforms. So why would this be kind of important to me? Well, I can go down the list and say, you know, today, with today's big market movement, we had 229 stocks that generated daily buy signals. So I go here and I format this, and it says, oh, it's including all NYSE. Let's knock that off the list. And then my own little private list of stocks that I'm looking at. So let's just run a scan live right now with you guys I pray that this goes through and works. And let's just run that scan, and we'll find out kind of what is important to me is how to figure out not just how many stocks are going up and how many stocks are going down. Many of you might be familiar with the term called advanced decline analysis or breadth analysis, but this gives me a little bit more of a testifiable indication that we've got actually buy signals in a market. And then with today's action off the lows, we really only generated, and I just ran this scan live with you, just if you look at the format, it's only S&P 500. So today, with all the action that we saw the market bounce off the lows, the S&P 500 only generated these 13 names. All right, Fifth Third Bank, Chesapeake. So that wasn't like a heavy concentration of individual sectors. It's a kind of a, wouldn't you call it a hodgepodge of sectors? Noble's in the energy, Humana is in the healthcare, Fifth Third's a regional bank, Delphi Automotive, Discovery Channel, Chesapeake Energy, I mean, Aetna's the insurer, and then again, Walmart, right? So to be honest with you, I don't really see a whole lot of change there. Now, why is that important to me? Many of you might be familiar with what is called the advanced decline analysis, and many of you would be surprised because last night at the traders at this World Money Show, the Las Vegas Money Show, I did surprise a bunch of people, and I'm going to share that with you tonight. I've done it before, but many people utilize breadth analysis based on the NYSE, the New York Stock Exchange Composite Index, and we're going to go over that a little bit. This is actually the advanced decline, and the theory is the more stocks that rise in association with price, it shows that there's a stronger breadth, a more robust rally. It's a more broad-based rally, and it's healthier. And most people feel that the New York Stock Exchange Composite Index is broad-based, but I'm going to share with you tonight, it might be a little too broad-based and may not be concentrated enough on what we need to focus in on the market. Many of you might also agree with the fact that this has been kind of a sector rotational type grinding market, but it's also been not just sector rotational grind. Like, for example, they get out of utilities and they get into biotech, they get out of biotech and they get into energy, they get out of energy, they get back into energy, and they get back out of energy, and then we go roll around right into medical, we go into drug stocks, then we go into technology, and it's just been one big, hodgepodge. And then now in the last week and a half, we've seen an uptick in the financials, Bank of America, Goldman Sachs, Morgan Stanley, JP Morgan. So we've seen a lot of sector rotation, and that I think has been kind of confusing the average investor. So what you're looking at, a bunch of these colors, you may see that we've created and have the advanced decline on the Dow Jones Industrial Average, which is only 30 stocks, the NASDAQ 100, the S&P 500, the Russell 2000, the NASDAQ Composite, and then again, we do look at the New York Stock Exchange Composite Index. Most platforms will share with you only have the advanced decline comparative ratio line constructed easily for the NYSE. Now, if you want to see like growth stocks and see what the health of maybe the Russell is, it would probably be important to look at an advanced decline analysis of the Russell to see, is this sell-off coming down with more stocks falling than rising, and that would be more stocks declining than advancing. So if that's true, if more stocks are actually going down in conjunction with the index, then it shows that the market is actually weaker than what people suspect. And it would show that even with, like, for example, today's rally, we actually didn't see, as you can tell right here, an uptick. We saw a downtick in the advanced decline today. So it doesn't really bode really well for at least today or tomorrow that this index is still out of the woods of wanting to test the lows again. Looking at the S&P 500, when we take a look at the advanced decline, you can almost literally see, if I draw this little rectangle box here, you can almost literally see that from a given point in time, we see like a light switch: sell them, buy them, sell them, buy them, sell them, buy them, sell them. And so we've actually been doing nothing but doing what the market price is showing and reflecting. We're in a trading range. So the market still is maintaining a trading range environment. And until we break out of these highs and break out of the highs with what I'm looking for, market participation or breadth, and then B, a more volume behind it, we're going to be remaining in a trading range. The real line in the sand for me, by the way, is, and I'm going to draw it right off of that swing low, as you can see. Note that we've been coming down to that swing low, and it exists in the other markets as well. So from a technical perspective, and I'm going to show up this little view data window here so you can see it directly for yourself, and write it on your calendar. It's April, It's April, and you can see right here, that red candle right there, it's got a little sell signal, April 17th. You know, if we've tried to test it once, twice, we broke it the other day, last week, we came back up. If we break that level low, and when I mean break, I don't mean by trading below it, I mean closing below it. If we close below that level and we start to see a breakdown of this advanced decline out of that range, so in other words, it's going to be a two-part situation. A breakdown in price accompanied by new reading lows in the advanced decline on the S&Ps, then we have a more significant correction underway. Define significant. At this point in time, I don't think the market's going to stop at the March lows. I think we'll probably come back and want to test as we were back here when everyone was like scared to dickens at the end of January into February. I think we come back down and we test that low one more time. That is the area that I think, from a technical perspective, some of the tools that I'm utilizing here, as well as measuring the yardstick. In addition, the person's pivot, as you can see, it's kind of interesting here. The monthly pivot has been holding at 2044 in the ES. Now let me change scopes for you here, and we're going to change this and flip this over to the spiders. Now, one thing I like to share with people is there are certain times that I want to be looking at the futures, and there's certain times that I want to both be looking at the spiders. And the funny thing is the spiders also that same day, because the reason I look at both the futures and the cash market, real simple. Futures trade 24 hours, cash market doesn't. But there comes to a time every quarter where we do something called the futures expire, and we roll out of the near term to the back month. Now this is May. It's the middle of May, and in about 3-4 weeks, we're going to start to roll out of the June front contract month of the S&Ps and go start trading in the September. And that will wreak a little bit of havoc with our technical indicators. So as a gauge, because there's generally that premium or discount, if you may, between the front month futures and the next back month futures. So from the June to the September is probably an 8-handle, 9-handle difference in pricing. Whereas in the cash market, you don't have that little problem. But clearly, as I share with you this little chart, you can see that every time we've dipped down into these lows from a technical perspective, I mean, we bounce right back up. But when we do bounce up, we're not bouncing up with a lot of fortitude. Now, just the other day, we did break out and make a new high, almost a new closing high in the S&Ps, and almost a new high in the advanced decline. We took out that last peak, which normally would be bullish, and then what happened? We sold right back off. So we're not ready to break out of this range yet. So I can't really say that, to be honest, we're still in this trading range, and there it is. And what I would say is, though, based on where prices are, and based where the advanced decline analysis is, on a given end of week period, I'm more thinking that we still have a little bit of life left to the upside in the market. So this Friday, I want you to pay attention to where the market kind of closes. But what I can defend against, and I'm still staying bullish in the market until we actually close below that April 17th low. So first and foremost, from a technical perspective, you want to mark that April 17th on your calendar, because that really was an important posturing of a technical perspective in the S&P 500. All right, so I wanted to get that out of the way and just share with you that when I look at certain candle patterns, I'm looking at maybe not just my high closed doji, low closed doji, but as you can see down here, as I've pointed, and I'm going to point out to you real quick, I also use a couple other things besides looking at the person's pivots. And let's get a different color. What do you say? Because that didn't look very good. Besides looking at the person's pivots for indications, for when it comes to stock indices, we have an exclusive analysis tool called breadth analysis, and that's what I was sharing with you tonight. And that's kind of an important element in trading, especially stocks. Now, I would like to share with you as far as stock picking, and I know that everyone has different performances, but I work together with another guy, Tom Ashbury. Many of you might be familiar with him. We're 18 weeks into the year, and now we've only had 28 trades. We've had 20 winners, 8 losers. This is PA Stock Alert. This is every single trade that we've put on. We have a couple still open. One's in the financial KBE, as you can see there. And we're up, with open closed position about 52% right now year to date still. Closed out position 37%, so we're letting some ride here a little bit. And we did have one option trade. You can see at the bottom there, it's the USO, which we did not include in the performance. You can see it right up here, USO. We did not include USO for one reason. We really can't tell how many options a person may have taken or didn't take, and so it's hard to manage what the performance really would be. So we just said, listen, we bought these at 120, we sold them at 160, we tried to let it ride, just didn't happen, and that was back in January when the world was bearish on crude oil. With that said, we've had some energy selects. We've been switching around in different segments of the market. It has been a trader's market. And with PA Stock Alerts, what I'm just sharing with you is, what we've put together, folks, is something I think has all come about by everything that I'm sharing with you tonight. We run scans. We utilize that person 12-point approach to the market. We try to figure out where the strength and the sector leadership is, and then try to pick out strong stocks in that sector. This has been, for some people, kind of a fun 4 months of the year, 5 or so. And for others, it's been a struggle. And I'm here taking a little, temperature at the money show. The funny thing is, Tom and I, we started working on this thing and running scans. And in 2013, great year, up over 90%. Last year, cumulative was only up 45%. So we've had a pretty good run. And, right now, I think there might be a little bit more left to the market. Now, what I feel that might be helpful is the first thing that I do, and in that 12 bullet point, I said, first thing that we do, we utilize certain tools. I run scans, and the neat thing about whether it's TradeStation or Thinkorswim or Genesis platform, they're powerful in helping us to be able to search for trade ideas. And the key is, though, what type of technical tools should we be using in this newfound millennium environment? I still think seasonal analysis is a very strong tool, but I always teach technical analysis supersedes seasonal analysis because not all years are the same. And in this particular environment, especially in May, if you look at the strong and you look at the weak column, you will note that it's kind of interesting in the sense that, number one, we actually have what you might consider to be a conflict of interest. And what do I mean by a conflict of interest? And I'll share with you that conflict of interest. We have a strong sector is the NYSE and the Qs. And then in the week, we've got Diamond and S&Ps. And the funny thing is that these denote maybe towards the middle of the month, and these denote weakness towards the end of the month. And we also have a couple that you look at here and you go, KBE, John, you're long that. Well, it is strong, and you're right. And then you look at the financial XLF, and it's weak. And the XLF is actually a diversified financial ETF. It's not a pure bank play, and that might be the difference. So we have to kind of drill down, not just a broad-based, like people think the XLK is a pure technology ETF. Now, if I'm going a little bit too specific for you, I think this is the kind of information that helps people really pinpoint better trade setups. In other words, find out where's the money going? Is the money going into high dividend yielding stocks like the Dow, or is money going into small cap growth stocks like the Russell 2000? Or is the money going into the NASDAQ 100, which has a larger exposure to technology and biotech? I mean, that's not that hard to see that, right? Or to understand. It's not that hard to learn that. That's more important. It's easy to learn. And that's what I'm here to help people with. I think that we also have a couple things that we would like to share with you. Like, for example, certain foreign markets may offer some intermediate selling opportunities. One is the EEM, the emerging markets. There's actually a nice little ETF you may want to look at. It's called the EDC. It's a 3-time ETF on emerging markets. So for you stock traders out there, we are recording this, so you will have a chance to look at some of these and review this if you'd like. Also, we have a kind of a change of guards when we leave May and enter June. We have seasonal lows for some commodity prices like sugar, which begin in May. And in sugar, I mean, not many of you are going to be going out and trading sugar, believe me. I don't remember the last time I traded sugar. In fact, I think I'm famously quoted as saying, I don't think I would trade a commodity they give away at restaurants for free. I mean, think about it. You go to a restaurant and get coffee and get all the free sugar you want. I mean, I'm not sure about trading sugar personally with that content. But here's one. Volatility for stocks actually peaks. The VIX, it's not 100% that we see the VIX or the stock market crash in May. And that's one of the things I think is a strong message here at the Money Show that I wanted to share with people. And my equity outlook from mid-May into late June still remains bullish as long as the technicals agree. And I just gave you the defining point, the line in the sand. So I kind of went out of order. I wanted to share with you what kind of technicals I'm talking about, number one, and what's that technical point, that line in the sand that we cross or we breach. When do we start turning bearish the market? Okay, so here's a little interesting scenario for you guys. This is the VIX, the Market Volatility Index. And the funny thing is that while we have seen it trade a little bit lower, we're starting to grind out with some areas. As you can see, it's not absolute that it has that line in the sand of making lows. We're actually more in the average range of the VIX, but note this little seasonality trend tool in the VIX. The funny thing is it doesn't trend up in May. It actually trends lower, and here's what I want you to focus in on, because this might be important, because this actually does. It's a very interesting thing, so it's a coincidence that might occur. I want you to write it down. I know we're months or several weeks ahead of schedule here, but the VIX actually makes an annual low. Traditionally, it actually has more times of an annual low the first week of July. Now think what happened last year in the market, and that's kind of interesting because last year, the market had more of a significant sell-off. It was brief, but it was more of a significant correction in July than it did in May. And now, 1 year does not change the whole scheme of things, but right now, we're like midway through May. We got option expiration this week. Janet Yellen's kind of, got people concerned. We've got Europe, we've got the emerging markets, we had bonds, the Bund, the German DAX. There's always a wall of worry, and yet the market itself is just kind of grinding sideways here. So the VIX, from a historic standpoint, looking at seasonality, it was surprising to a lot of people when I shared this slide that, hey guys, VIX traditionally, it's like late June, July that we make that little move up, which means you typically get perhaps portfolio adjustment or protection in July as traders start to maybe take that summer vacation in August, right? And we get into September and then, of course, the October markets. And that's when we make our annual lows in the VIX. And so that I thought would be a nice way of presenting to you guys tonight. Hey, here's what technical conditions we have, and here's some factual hardcore information. Now, you probably, if you're an equity trader, you're familiar with this product, UNVX. And what I wanted to share with everyone is for the May expiration, and this was yesterday, I took this screenshot yesterday, we saw a little bit of volume in the 10 strike calls yesterday. But when we came in this morning, and anytime you look at an unusual volume activity, I never try to piggyback a trader. I think that's a mistake. What I try to do is find my own information based on a set of facts, based on technical indicators. And then when I start looking at the market, when I see an unusual activity, I go, wow, that kind of mirrors my own analysis. I don't like to say, oh, there's unusual option activity, because purely in of itself, friends, when you look at unusual option activity, we don't know if that's someone offsetting, and I know that for every buyer there's a seller, but the funny thing is we had a 5,500 volume with a 5,700 open interest, and today the open interest only changed by 300 contracts. So just because there was heavy volume does not mean that someone initiated and held a new position. Maybe that someone just day traded around that position and we didn't see a huge change or a net change in the open interest. So I think that's one of the things, another message that I wanted to bring to the table as well. Better market analytical skills is what we need. We need the ability to anticipate market opportunities, and we need to make trade decisions based on facts. And that's what we try to teach people. If you had a better skill set or maybe tools that were more designed for today's market environment, I think you'll have a better shot at trading. Designed for today's market environment, I think you'll have a better shot at trading. Now, I want to bring this chart to your attention. This is a weekly chart on the New York Stock Exchange Composite Index, and more importantly, this is the advanced decline comparative ratio line with a proprietary little moving average that I overlaid there. And as you can see, just like in moving average school, look at the moving average. Is the moving average sloping up, slow and steady? Is the moving average, and again, this is live, this is as of yesterday, okay? And as you can see, May right here, and this was yesterday's trade. So, I mean, looking again at a weekly chart, it's, you know, it won't update until this Friday. It's a weekly cumulative chart. But the point I'm trying to make is that this analysis shows that the trend is still up, and until we break the trend, until the market starts to break the trend and price might see a more meaningful correction, we're still in an uptrend in price, and it's still looking healthy on a week-to-week basis. Now, to the regular individual using the NYSE, they feel warm and fuzzy and comfortable. Here's the problem I have, and this is what I want to share with you, and this is a very, very important lesson. 30 years ago, when I first got into business, by the way, the CAC 40 hadn't even been invented yet, right? They hadn't even started trading stocks in Paris. The most amazing thing is now is that the New York Stock Exchange Composite Index is not a pure US-based stock index. There's actually only 68% of the companies that are listed in the NYSE are US-based companies. There's 1,887 names listed as of last month. Here's another interesting tidbit for you. The heaviest weight is in healthcare with 20%. Then you have oil and gas, 16%. And here's the worst part. Real estate REITs and bond funds, which are priced or valued in price. So if bonds go down, then the sector that weighs in with bonds will also show the advanced decline collapsing or showing more issues declining for that sector. So if you had healthcare take a little downspin, if you saw oil and gas stocks go to the downside, if you see REITs, real estate investment trusts, and bond funds go down, so if 30-year bonds go down or if TLT goes down, you know a bond fund has lost money today because that's what they're trading, right? And it's valued in price. Guess what? It's going to be listed in the NYSE, and that will weigh on the NYSE, the New York Stock Exchange Composite Index's advanced decline ratio. Why do I share this with you? Because the few or the people that do use advanced decline may use another tool which is very popular in nature, and you're probably familiar with this. It's called the McClellan Oscillator. Sherman McClellan created this indicator based on a series of moving averages that measures the net change of the advancers versus the decliners in the NYSE. So remember I said, guys, we need to be a little bit more astute in the tools we use. First off, some people might say, John, I don't even use advanced decline. And I would say, well, you should. And if you're going to, because it makes sense about the breadth and the logical aspect of the market, it makes sense to see if the participation rate is strong. You know, the old phrase, rising tides lift all boats. And the more stocks in an index that go up versus a few heavy capitalized weighted stocks that can influence the market like Apple used to do, right? Then it makes sense that we want to take a measurement of the stocks by the index, by the breadth, the amount of stocks going up or the amount of stocks going down. And so it's really important to understand what the heck you're using in this current market environment. And when I told you that we need to be more specific in the tools we use because things have changed. 30 years ago, you did not have as many foreign companies. You didn't have bond funds. Heck, we didn't even have real estate REITs 30 years ago in the market. So if you're looking at breadth analysis, make sure you understand what the hell it's designed for and what it's based off of. So I thought that would be kind of a, since I gave this to the Money Show folks, I wanted to make sure I was fair and impartial, and I thought tonight would be a really good way of kicking off mid-month. Now, you guys know you haven't gotten an email probably from me in a long time doing these webinars. I haven't offered one in a long time. We've been busy. And I thought that tonight would be kind of important because it is that quote-unquote sell in May, go away time frame. There is a lot of, here at the Traders Expo, it's very mixed. I mean, people are kind of scared that, a lot of people are very perplexed, the lack of volume. And I don't know if you guys out there feel the same way, but I think that, we've been doing pretty good. And this is what I'm afraid of in the market is that traders, we're like conditioned for this choppy little market environment, right? And so you look at a lot of stocks. I mean, when you get a 3 to a 5% move in stock, except for, of course, in earnings over the last couple weeks, which was kind of interesting. But if you get a 3 to 5% move in stocks, I mean, that's been about the norm, and then they peter out. 3 to 5% upside, boom, they peter out. 3 to 5%, boom, they peter out. That's been about the norm. Here's my thoughts on that. I think I want you guys to be careful that we're being conditioned to taking quick profits. If we see, and this is a chart of the S&P 500, by the way, and this is, as you can see, it does have a little seasonal downturn in the first week, and then we go up, and then we turn down towards the end of the month, and after that, we skyrocket going into July, by the way. That's the seasonal trend of the market. And it's actually kind of doing that, right? It's actually kind of doing that without going anywhere. So a lot of the other price-based oscillators, they'll be kind of, as we move sideways, from a technical perspective, they're going to be working off that overbought market condition, kind of like. And here's the thing. I look at the participation, and if I thought that this market was going to turn its head on a dime, one of the tools that I would rely on would be, is the participation, are we still seeing an uptick in the amount of stocks? And the answer is yes, so far. And this is, again, a weekly chart, but this is also the advanced decline that is specific to the S&P 500. That's what I'm drawing in there, the S&P 500. And so the S&P 500, and this is kind of what we've seen happen. The social media stocks got whacked at the knees, and towards the end of the month, even though there's a very short history for social media stocks, I did a little write-up, guys. I posted out every week. I don't know if you get a chance to read it. It's my weekly thoughts and observations. You can see that if you go to personsplanet.com, and let me open up a browser. I'll share with you where to get that if you haven't seen it before. What we do is you go over here, we send it to email to our list. Some people get it, some people, I don't know, they don't open it, they don't know what it is. That's okay, but you can go, it's not password protected, and you just click on there, and these are my thoughts for the week, and I always give a kind of a message, a positive thought, what traders should be doing. Every week there's a different message. And here's my little thoughts and observations. Here's what the market's done. Here's the sectors that I'm looking at, right? And of course, here's what did happen. Last week, the biggest losing sector was XOP. It was down 4.27, and this I'll get to the point in just a minute. Social media stocks. If you haven't read this, you want to read this, because even though social media, and you can look at it by the SOCL, it's an ETF that tracks mainly Chinese stocks, but it's an ETF that's been listed since November 2011, so we don't have a lot of history to run seasonality. But the funny thing is, it has in those 4 years a tendency to peak in April and bottom in, keyword here, late May. Late May. So again, this might be a good, night that we sit down and I say, hey, here's some tools that are working in this environment, number one. By the way, here's what they look like in conjunction with the person's pivots indicators. And more importantly, here's some sectors. So we take a look at, besides Yelp, which announced that they want to be, bought out, but Pandora, and Twitter, and even LinkedIn. We might not get near those support levels, but as we grind forward into the end of the month, I'd be really focusing on, as everyone loses perspective of the stocks, they lose focus of the stocks, they give it up, they're bored with it, and all of a sudden, bang, it pops out of nowhere. You want to keep Twitter, LinkedIn on your horizon, on your radar screen, and running scans in that sector as we get into the next week and the week after, all right? Anyway, you can go down here in the list, and then we put out some of my technical points of interest. As you can see, I do talk about the McClellan Oscillator, and then we go through stocks that I like and what sectors these are. Of course, you'll find many of these sectors are, and these stocks are in seasonally strong period. What a coincidence. And I put in what are the May and the weakness of sectors. For commodity traders, I always put down some seasonal spread trades that have about an 80% or better probability or historic success rate, and the dates of when you get in the spread and when you're supposed to exit the spread, so you guys can watch that. Like, for example, you buy Dees corn and sell SEP corn. It's kind of like a new crop and quasi-new crop. It's a bear spread, actually. You're bearish on the corn. Nat gas, it's another bear spread. You buy December, the back month December, and you sell the near term, July nat gas. So that information is there. Reports, so that you print it out and everything's on one sheet. I know that tomorrow we got retail sales coming out, Atlanta Fed, business inventories, all right there. And then for stock traders, hey, what are the big names that are coming out? By the way, I really thought Zillow would have more of a downside action tonight after earnings. It had a very muted event. But needless to say, this week we got Ralph Lauren, you got Macy's tomorrow morning, you got JCPenney, Shake Shack, Cisco. So we still have some little volatility left in the market. And then again, we let you know where we're going to be. We're in Vegas. We got a live seminar here in the end of the week, May 15th and 16th, Friday and Saturday. But this is stuff that I like to put out for myself. We give it to our trading community. We send out an email. We post that. It actually keeps me focused on the market. and I do my little work and my analysis. Now, I wanted to share with you on the one bullet point about emerging markets, and I wanted to share with you a fact about seasonal analysis. It seems a lot of people are diving into learning more about seasonal analysis, and I want to precaution you. Remember I said that technicals will always supersede seasonal analysis. And before you dive in and say, oh, look, I got a seasonal tool, and it shows that, boy, there's a particular time of year a market sells off. If you're using a market that you're not sure it has longevity, like 25 years of history to it, and it's only been around for 4 years, I mean, how much seasonality on a historic basis can you extrapolate data to trust on a 4-year backtest? More importantly, when it comes to an equity product or an equity index product, you probably want to find out, or an ETF, has that ETF had a split? Has it been repriced? And when do they normally do it? That becomes more devil in the detail-ish when it comes to seasonal analysis, doesn't it, right? So you'll do your homework and your, what we say, due diligence a little bit better, which doesn't make you smarter, it just makes you, well, yeah, it does make you smarter. It's like staying overnight in the Holiday Inn Express. You're a little smarter. And with the emerging market, while it has been around a little while, note that it has been repriced, and it has had 2 splits. Coincidentally, those are pretty big splits, guys and girls. Those are pretty big splits, and you can see them right there on the chart. When are those splits? June and July. So perhaps it will skew and show you that, oh yeah, this thing peaks out in May and it goes down into July, and it's going to alter the seasonal tool. So before you go and say, gee, I emphatically trust that seasonal trend tool on whatever platform it is, pick up a chart, go look at the monthly chart or a quarterly chart of that, look how far back that information goes, check to see how your seasonal trade or your seasonal tool, what it's measuring. Is it only measuring 5 years or 7 years? That's not enough data. Is it going to the life of the history? Was there a split? Was that split in that particular time period? Does that ETF or those fund managers are managing an ETN, an exchange traded note, for example, do they somehow run those splits at around this time of year? And then you'll get a better, and you'll be better prepared to say, well, maybe I don't trust it as much, and therefore I think that's going to serve you a lot better. So before you just start looking at seasonal analysis, believe me, there's a lot of little nuances that you need to be cautious and paying attention to. I hope that actually shed a lot of light on what's going on, because it's funny, because as I get older, it seems everyone's in the know about everything. But, you know, when I used to do a CNBC spot back in the late 90s and early 2004, I'll tell you right now what's really amazing. And here's a little something for you guys. You may know, a little trivia. You know, I was officially the third guest on Fast Money when Dylan Ratigan started Fast Money. And Dylan Ratigan, I'm here to tell you, was, what's the nicest way I could put it? Rude. Anyway, the funny thing is, I was like pre-warned. I couldn't use the F-bomb, and I couldn't use the O word. And the F-bomb is not what you think. It was the word Fibonacci, and I couldn't use the O word, options. So it was kind of like, if you think about it, everyone's a Fibonacci expert on CNBC now, and everyone's an option expert now. It's just amazing how things have turned. And I guarantee you everyone is starting to learn about, hey, the seasonal analysis thing. And there are tricks, and you got to do a little bit more work. You know, when we did the Commodity Traders Almanac, you know, if you look at an old copy of the Commodity Traders Almanac, you will note there was a specific reason. I believe we took a 25-year historic chart or data, and we compared it against 7 years as a current market environment. And if the near term or 7 year overlaid and still adhered to the longer term 25-year, then it gave us a little bit more sense that, you know what, the seasonal supply and demand changes have not been altered to a degree, right? Doesn't that make sense? If you looked at an S&P chart and you only had 4 years of data, and you go back and you go, wow, this thing has, you know, it's a great looking seasonal chart. And it might be great because in the last 4 years, it's just been a bull market. And so if you compare it to maybe the 4 years of 2005, 6, 7, and 8, I bet you that seasonal, looking at that data sampling would look a lot different, right? So you got to look at the entire picture. So when I tell you my 12 points of technical analysis, there are specific tools that we utilize, number one, and number two, you have to make sure that you adjust and are understanding of the market environment and the conditions in which we're in. So when we look at the EEM now, and you look at this weekly bar, and you say, gee, wow, look at this. Man, that has a strong tendency to fall from late April into July. And because of the prior chart, you might have a better understanding of why we have a stronger seasonal downtrend. So for example, in 2014, you have this seasonal trend, and no offense, it didn't work too well for you guys, right? So seasonality is not a single lone tool all in of itself. We need, as proof pudding, to utilize technical analysis, all right? Now, the funny thing is, this is another form of technical analysis. This is what we call a percent ratio chart. And this is from my Genesis platform. This is in the John Person package. The funny thing is that this particular chart shows all the special E's. The E's, I call them, are the emerging markets. They're all the foreign stock sectors that are dollar-based. So the EWG is Germany, so it would be the DAX or the German markets, but priced in dollars. So if the dollar was down against the euro, or the dollar's up against the euro, excuse me, and you converted dollars to euro to buy the DAX, and then came back, made money in the DAX, and converted your euro back to dollars, you would have a loss on the currency conversion. So if you lost 7% on the currency conversion, but the DAX is up 19%, it's 7% minus 19, you're actually only up 12%, right? So this actually takes in that account. So as you can see, this little purple color, it's kind of the emerging markets. From a technical perspective, we're starting to see the emerging market, which was, you know, at the beginning of the year, and this is what this measures. In order to figure out where a stock or a sector might go, then ask yourself, where the hell has it been? That makes sense, right? And so where has it been relative to the rest of the markets? So you got Germany, France, Italy, emerging markets here, and you've got the S&P and the Dow here, okay? Now, I'm pretty sure one thing or another is going to happen. Either this segment of the market's going to come back down and join the party down here, or these guys are going to come back up and join the party there, or maybe it's a little bit of combination of both. And that's what I'm kind of thinking in here. It's probably a little combination of both. So with the emerging markets, yes, while we do have seasonalities we're on guard, might not be tremendously reliable, I would say that it is starting to show some technical weakness relative to the other counterparts in that space, meaning Germany, France, which is EWQ. So in case you're not familiar with these ETFs, these are the names, and as you can see, I'm comparing Latin America, which is an ILF, EWQ, which is France, EWM, which is Malaysia, EWI, which is Italy, G, Germany, emerging markets, and I'm comparing against the Dow and the S&P 500. All right? So that gives us a better perspective of figuring out where stocks or sectors might be. The funny thing is, in the EEM, as of yesterday, big number here, man. Someone was looking at about 42,000 calls with approximately 43,000 open interest. And that was the 42.5. And these are the options that expire this week. So I'm looking at this and I'm sitting here going, hey, tomorrow, which was today, I want to see if this open interest really changed, which it actually did. It went up a bit. So the funny thing is, emerging markets today, I'm not sure if you follow a lot of the emerging markets, but I believe in that term, rising tides lifts all boats. And when we take a look at those foreign markets, the EEM settled today at exactly 42.50. So I'm not sure these guys know what they're doing almost precisely, but someone is pricing in a market, at this week to pin against that 42.5 in the emerging markets. Note that in the next month out, or even these weeklies, there's really not, there's not any big open interest in this market whatsoever. It's all in this front month right here. So we'll be tracking the emerging markets to see if it continues to melt down a little bit. And I know that one of the things is that you constantly hear, oh, you got to have exposure to Europe and you got to have exposure to emerging markets. I don't really buy that right now. And with the fact that apart from those two big splits that occurred in June and then in July, I have to say that running a scan on Thinkorswim and running a scan on all my platforms, the PPS indicator is going to, if we close here or lower, we're going to generate a weekly sell signal in the emerging market index itself, by the way. So there is a neat way of looking for trades and using those the tools that we've pointed out. So where's Person's pivots in all of this? It is amazing. And then I'm going to tell you right now, if we take a look at, just to go through, this is the emerging markets. And as you can see, this is a weekly chart EEM. And now the week's not over, so we got to wait till Friday. But boy, we're going to generate a weekly sell signal, and it's below the monthly pivot, which is the blue line. So if we close below what was support, it gives me an indication that the next stop would be pivot support, which, by the way, is all the way back down here at around 40.80. So maybe someone who wanted to take a, and I'm not saying this is the greatest trade in the world, but, I would say it definitely is useful, helpful tool to say, by the way, seasonally, this is a sector that goes down. Technically, it's starting to show some weakness. And third off, it's generating a sell signal, and if the market closes below the monthly pivot, it probably is going to do what? Want to expand that range and get down to maybe near the monthly support, which not that I'm really all that trusting of, but there's this little shelf of old resistance which might turn into support and a gap in the market down below. So perhaps maybe if we do Friday generate, or we're close to the close on Friday, and we may want to do Friday generate, or we're close to the close on Friday, and we may want to be looking at, in a situation, and this is just a trade opportunity, options, as you could see, the front month had pretty good volume and open interest. The other weeklies aren't so good. Where does pivot stand for other markets? We gave this out last night at the Traders Conference here in Las Vegas and said, hey guys, the TLT, we're trading near that green support. That's Person's monthly pivot. Now, I don't care if you have Thinkorswim, TradeStation, Genesis, you should have monthly Person's pivot support right about damn near where the market ended up today. Now, this is the TLT, and my momentum histogram is showing that it's running out of speed to the downside, which typically, I'm not saying that bonds are going to, regress straight back up. But what I am saying is that typically we go from a phase where we go from a trend, and then we go into a pause. And I think that's what this market's going to do, go into a little bit of consolidation. And that, my friends, coming off against monthly support. So when I tell you, yeah, monthly pivot's very important, we could stay in a little range. We've got a little bit of loss of momentum here in the market. And so I think, and that's what we were doing today, was putting on this morning on the opening, the 119.17 first week July. I don't want a whole lot of time. I want too much duration. And I wanted to be a little directional off of those lows, which we did get. So I think the market might bounce a little bit or pause, allowing for some theta decay. Nice trade. And again, it had a lot to do with, of course, monthly person's pivots. So yes, they're very, very powerful tool that helps uncover not just the direction looking forward. You know, the market actually gave us, what do I say by direction? At the end of last month, notice what it's done. It gave the blue line is lower than the prior blue. The red is lower than the prior red. It's projecting lower highs and lower medium price, which gives you a bearish outlook, right? So it's giving on a monthly basis. It's been giving bearish outlooks, giving us forward direction. Now, when a market hits support, I don't like to sell support, and we might just stall. Perhaps we generate a buy signal, and if we do, then we might look at more of a directional call. Right now, I think the market pauses in the bonds. It's had a pretty significant downturn. You know, and the funny thing about bonds, and just to talk out loud, the funny thing about the bonds, everyone was been talking about when are bond traders going to come out of bonds and get their money out of bonds and go into the stock market? When are they going to do that? And I'm kind of wondering, I'm like, this is a pretty significant decline after Janet Yellen, and we've gotten all this reports about the economy not doing great, poor jobs. If you think about it, we've had revisions saying, oh, those old reports in January and February and March, yeah, they weren't as strong as what we thought. We revised those, and we don't have a lot of people employed. And now this last jobs report wasn't stellar by any stretch of the imagination. Janet Yellen, can I trust that she says one thing and does another? I can probably trust that. But needless to say, what is the market telling us? And I think what the market was telling us is it was getting prepared. It was getting prepared for maybe a shock to the stock market with a rise in interest rates. But now the market might be taking that shock out and getting ready to put money to work, perhaps in the stock market for the next 6 or 8 weeks as we get into July. It's just a theory of mine, but I could tell you, you know, when I look at the AD lines, I don't see everyone leaving the equity market either, right? So maybe that might be something we need to kind of continue to watch. But either way, the technicals with the person's pivots gave us a bearish direction for this month. It gave us the support and resistance level. And when we combine that with my PPS buy and sell indicator, it can really help us and be best used to run, as I say here, scanning for trade ideas. So tonight, I just wanted to share with you in the energy sector yesterday, running scans, you can, with Thinkorswim, you can scan in any sector, any stock, ETFs. I mean, gosh, the list that they give us is amazing. This is the energy sector, which I ran a scan to say, by the way, if the market right now closes here for all of these names, you know, some of them you might know, like ConocoPhillips, Hess, Marathon Oil, Occidental Petroleum. You might be familiar with some of those names, right? If the market closed at this threshold or price, if it closes that threshold of price, in the energy sector alone, we have 34 names that will generate a weekly PPS sell signal. Not entirely bullish. Now, at the end of the week, I'm going to run a scan again and say how many stocks are in a buy signal and how many are in a sell signal. And that, my friends, is a neat way, a very neat way of doing what? Taking a better advanced decline in the health of the market. If I generate a boatload of weekly sell signals, then I'm not looking too promising going into the next week. Would you agree with that? And I've already shared with you my scans of how we work them and a little bit more hierarchy advanced of some of my indicators and thoughts that I've published in my writings and books through the years with TradeStation, like the high close weekly and low close weekly and daily and these other specific scans that we utilize. So there is a way, I think, not to overemphasize and overstudy, but to get more testifiable evidence and facts before you put trades on, and then say, hey, listen, we've got a great little trade. Now, on Friday, and as a disclosure, I don't BS you around. On Friday, running a scan. Friend, compadre, partner, we started this little fund together, by the way, in the month of April. We're just up a little bit over 3%, just trading a little bit here. The interesting aspect is we were talking about running a scan, and incidentally, the funny thing is this one name popped up on the scan, and I'll share this with you. And it was a a textbook John person kind of setup. Now, as a disclosure, I'm not saying I did not take the trade. It was not we were joking, and it was kind of like, really, you want to get into this stock? Really? It was kind of interesting. So I'm going to share it with you real quick. So the funny thing is, this is a weekly chart. It was AOL, by the way. And on a weekly chart, we did have as you can see, that orange candle is a weekly high close doji. So I wanted to share with you something here. Here was the weekly buy signal. The market had this nice little rounding bottom. We saw an incredible move with my momentum indicator going more positive. And this was last week, and this was now, follow through. So there is a difference of watching for different indicators and then running scans to get a heads up. At least I had the choice that I failed to take this trade, and I think it was joking in my office. It was kind of like, you got mail. Are you sure you want to buy? You got mail. But folks, we take a lot of trades like just that particular setup, and we have that scanning feature, as you can see, almost in every one of my platforms. That high close doji that I wrote about over a decade ago that I've taught people, it really meant something. There were specific rules. The PPS indicator, it all plays together in helping us signify and getting better trade setups. Now, I hope you enjoyed tonight. Here's how I can help if you're looking to get a little bit better and put things fine-tuning. You know that if you're not familiar with it, let me make sure perfectly clear. Person's pivots are free on the App Store. The daily Person's pivots, supposedly it's the most popular item in TradeStation's history of their App Store, which is relatively new, so that doesn't mean a whole lot, right? But it is a very amazing, popular downloaded product, the free daily Person's pivots. However, with Thinkorswim, you get all my Person's pivots timeframes available for the most part, as well as my PPS buy and sell signal. I do have an offer tonight that I think, if you're not familiar, if you didn't take advantage of this before, it is my study course. It is my, I think it should be mandatory for $229. If this is a joke, this should be mandatory for anyone trading in the market. That's a fact. If you've taken this before and you took advantage of it when we put this out at the beginning of this year, I've gotten an incredible amount of pats on the backs and compliments on this course. So with that said, it does help you put together the best time frames that we use. I mean, it's like 6.5 hours of instruction of how to use these scans and how to use it, the PPS, looking at the pivot points, looking at those support and resistance. Also, a couple of other things that we talk about here, like not only the Ichimoku cloud charts versus Bollinger Bands, because I know a lot of people still use those tools. And I kind of share why it's a little, maybe not redundant, but how the indicators that I've created are a little bit more effective. I'm not saying that you should abandon anything if you've been using, because they're still definitely useful tools. I'm just saying that I think there's better tools out there, especially in this time frame, especially a little bit of information on a specific volume analysis tool. And then as I went into a little bit today, comparative analysis trick using the indicator with not just the cash market like the spiders and the S&P futures. So this is like a dynamic little course. We don't really promote it a whole lot out there. We don't do a lot of stuff. We also have my breakout strategy. You can buy both of them for $4.89. It's the same offer we had a long time ago. You can purchase both of them. Shoot us an email on this. The bundle package is $4.95. You can come see us there. The courses are dynamic for people. We do have PA Stock Alerts, the advisory service. We have advanced mentoring, seminar here in Las Vegas, and our live trading room. And just to let you know, we just recently launched this hedge fund. Not lost, that would be a bad term, right? We launched this hedge fund that we're starting. Up 3% in a month of April, I think, was a pretty healthy rate of return in so far. So I'm moving in that direction. I think this is the kind of analysis that instead of teaching the professional traders, I'm going back into the money management business. Many of you do know back in 1986, I had a fairly substantial track record and did very, very well back in 1986, to say the least. It was a testifiable 3,615% return in 1986. I'll repeat that, 3,615% return in 1986. I traded bond options. I did learn directional techniques, leveraging my leverage on leverage. And I think in this environment right now, we have so many new products, so many great products to trade in the market, especially with equity-based options. It's just a really, I think it's going to be an exciting next few years. So there will be changes. We've got a presidential election coming up pretty soon. Brother and sister, we got some exciting times ahead, and I think we've developed a skill set of indicators to help us and to get this moving. So with that said, I hope you guys are doing good, and if you are interested, you shoot us up an email. I believe there is a link, if you'd like, on that. Yeah, I think the fund will be you don't try to kill it out of the box, but you don't have to sit there and knock your socks out either, right? So with that said, let me see if I can find that link for you guys if you are interested. And it's right here. So if you are interested, you can get that offer, $4.95 on that bundle package, and I will put that into the room here. You guys can take advantage of it if you'd like. And with that said, let me put that out there for everyone. If you're interested, click on that link. That should work. You can also watch the video and some of the information on how it all works, and we put it together, what it comes with. Really neat stuff. We have some great bonus there, 30 days of PA Stock Alert newsletter. That's the one that we're up right now, a little over 50% on that year to date, 28 trades, 8 losers, very manageable. We select our trades according to risk, not as much reward. We select what the risk factor is. Most people look at what they can make out of the trade. We like to look at, well, what's our potential loss first, and then we manage the trade. So in any event, this is kind of the information that you can find there. I want to say thank you all for spending time with me tonight, and I hope we gave you, what we promised. We tried to do that. I think that again, the tools and the techniques, they really haven't changed a whole lot, but I think it's the style of how we back tested, the style of following up with these products, and also since I hear so many people ask me about volume and looking at unusual volume activity seems to be a buzzword nowadays. I think it's very important not to go searching for the unusual volume activity. Look for look for your own ideas, and then when you turn to the options, that's the bonus right there. Okay. So Ed L., I hope you did well today. Harvey Schuler, you're a gentleman and scholar. Thank you for being here. Dave Patterson as well. I'll see you guys in the trading room tomorrow morning. And to everyone,